before, and then I'll let Jeff head on with it. I just thank you, everyone, for joining us this morning for this introductory call on an insurance provider to assist you in your practice. I have indirectly known Rod through Philip Simonson, and Philip Simonson is someone who I worked with back in the ING days, and he was my first boss and probably the best boss I ever had. So we have kept in touch over the years, and he has tried to promote a relationship or offered the services of their group for quite some time, and we just never could get things to fall in line. And so when we moved to Securities America, Rod was kind enough to call and ask me if we'd be interested in having some conversations. And Jeff has taken that on, and they've kind of put some things in place and decided that now it's a new year, it's a good time to make those introductions. And so I am very happy to have this relationship starting off here, and I appreciate you all taking the time today. So I'm going to turn it over to Jeff to make a few comments, and then let Rod go with all the great stuff you have to say.
Well, thank you, Lisa, and Happy New Year, everybody. Hard to believe we're already it's 12th of January already. It seems like we're having champagne, but oh well, that's the exciting part of life. So like Lisa said, we're really excited about kind of adding an insurance component as we move into best interest, more financial planning or planning component with our clients versus just strictly investments. And in this relationship, it's not just about an IMO, it's about people, it's about having the resources to take people that are either comfortable selling insurance and maybe helping them through the process to people that haven't sold any insurance before, and they'll hold their hand and walk them kind of through the process and get them comfortable, or actually do it for them if needed. So there's a little bit of everything for everybody. The talent that is there, we feel very comfortable with, and are just really excited to add another growth component to some of our reps. So I guess with that, Rod, no pressure on you, but it's now in your hands.
Great. That's beautiful. Well, I appreciate it. Thank you for your kind words. While Philip's never been a boss of mine, Philip Simonson, he certainly has been a colleague, a coach, and a mentor of mine. And I can easily see, Lisa, how he would be the best boss you've had, because he really cares, and he sure is a heck of a great guy. And I'm very appreciative to be connected to you guys through him. So thank you so much. So yes, I'm Rod Crandall, and on your screen you also see George Steele, who's labeled as Nathan Berglund. So he's on our corporate account, and Nate Berglund is the owner of USAdvisors. George is going to introduce himself in a little while. He may be your main contact, and I won't steal his thunder, but just understand you have both Rod and George here from USAdvisors. In the next 45 or 50 minutes, I want to try to be able to describe to you a little better who we are and how we work and how we can potentially help you and hopefully help you serve your clients at a higher level and drive additional revenue to your business. And we do have a reasonably small group today, so I do not mind at all to be interrupted, or if you want to raise your hand or you want to come in with a question. I mean, quite literally, I'm here for you. It's less about me needing to present my slides and more about me needing to get you what you need. So there should be time for questions at the end, but I do not mind at all being interrupted if you have a question or a comment or a potential concern. So with that, we are also recording this, and we will get that recording out to you. There's a number of people who maybe could not attend this, and they might be able to watch a replay as well. So just be aware of that. So with that, we'll get started. So the first question really is who is USAdvisors? And at a very high level, we are an approved intermediary for Securities America. So what that really means is we can support you in all lines of insurance business. And that includes fixed, indexed, and variable life, as well as indexed annuities and fixed annuities, as well as long-term care and disability insurance. So on its face, we're a brokerage firm that's approved by Securities America, but really we think that we're a little bit different than your average brokerage firm. And the real reason for that is we're an agency effectively built by wealth advisors for wealth advisors. And so we think that we really speak the wealth advisor language more so than the insurance language. And we really understand what it means to put together a financial plan and what it means to fund that financial plan with insurance. And so what you'll get from us and you'll see is that we're not very product oriented. We are conversation oriented. Okay, and we're outcome based. You're not going to get a lot of product information from us. Not that we don't have the product, not that we can't train it, but if you're like most registered reps, you're getting 30 or 40 emails every single day with a new product. And that's not the kind of marketing you're going to see from us or the message from us. What we're broadly doing is helping you have better conversations in context, presumably, so that we can focus on what insurance does, not necessarily what it is. See, at the end of the day, we really have all of the product. So leading with product is the exact opposite way. We need to lead with the plan, and we need to ask some good questions. And so a lot of what you're going to hear from us is what I consider to be identification, positioning, and implementation. So the identification is, who are we going to talk to? And so today I'm going to talk to you a little bit about maybe 4 or 5 different clients that you ought to consider talking to. So if we identify who we have to talk to, then the question is, what kind of conversation do we end up having? And that's really, how do we position what insurance can do for them in their plan? And if we can talk to the right person about the right thing, then we can ultimately implement and get them over the hurdle and get into underwriting. And if we do this right, what we effectively get to do is help clients and drive revenue to our practices. We get to keep competition away. We get to protect our AUM. And so hopefully here I'm going to show you sort of the inside track on how we view these things, and hopefully you'll resonate with some of these, and we'd love to be able to help you intentionally integrate insurance. And so this is me, Rod Crandall, and I started with Northwestern Mutual in 2000, and I felt that that job was a dialing for dollars job. I dialed for dollars for 5 years, and I didn't like it, and I didn't have that much success. And I thought, you know what, there's got to be a better way. And the better way was to work with wealth advisors who were already doing a financial plan and already had a high trust relationship. And so 15 years ago, I stopped working with Northwestern and I started serving wealth advisors and started training and coaching wealth advisors. And what happened was my implementation rate went from 20% to 80% when I started working with wealth advisors. And that was pretty incredible. And I thought, well, how was the implementation rate so much higher? And really what I've come to find out is it's because of the high trust relationship. I think it's very hard to develop a relationship and make an insurance recommendation at the same time. And so as much as it pains me to admit it, I believe a lot of people in the old days didn't trust me. And it wasn't that I was untrustworthy, it's that I called them at dinner and I asked to look at their insurance portfolio. And they go, well, who is this guy and what does he want from me? And I believe that the old insurance model is one of pushing, where you have to make 10 calls, 3 people meet with you, 1 person implements. And that's just not the right way to do it. If we're doing the right work, 80% of the people will implement with us because they already know us, they already trust us, we already have a plan done for them. And more importantly, we educated them in context. Okay. I believe in the platinum rule, which is that to the extent that I can understand and meet your needs, then my needs are met. So what we have to do is just focus on what our clients need, get them educated, and then they implement. And so I'm big on the word consideration. And what ends up happening is people don't consider insurance products, or when they do, they quote them in a spreadsheet. If you're quoting in a spreadsheet, we're already off on the wrong foot, in my opinion. Because insurance is always too expensive, and if you spreadsheet, all they're going to do is look at the lowest number, and it doesn't give the right context. And if we don't have the right context, we can't consider whether these structures are appropriate. And so I firmly believe that if we're after consideration, in order to get consideration, we have to educate. We just have to educate on the pros and cons. By the way, if we have all of the products available to us, then we can just shortlist the best 2 or 3 different options and educate them on pros and cons. And if they're going to consider it and we're going to educate them, that's what leads to implementation. And it's my belief that insurance isn't being implemented because it's not being considered. And a lot of times it's not being considered by the wealth advisor because they don't want to be perceived perhaps as an insurance salesperson. The underwriting process can be burdensome. There's a lot of reasons to ignore insurance, but none of which do the best job for our client, none of which drive revenue to our practices, none of which make our practices more valuable and keep competition away. So what we find is that we have to do these things on purpose. Okay? And so again, alluding to the plan today, in order to do something on purpose, we have to do it with intention. So how do we intentionally integrate insurance planning? And if you aren't currently doing that, then you've got to develop some new habits to the extent that you want to intentionally integrate. And that's really what hopefully you'll get from us and our team, because we've helped many, many advisors do just that, either through helping them do some business planning and directing them, or even have some doing joint work with me or somebody else where we just do all of the heavy lifting. So today we're going to talk a little bit more about what kind of resources we have. Going to talk a little bit about our team, and we have George here, as I mentioned, George Steele. He's Nathan Berglund up on top here. And then I'm going to share with you a couple of case studies and then describe what next steps might be if you like what you heard from us, and what can we do with this information and where do we go from there. Okay. So again, by intentionally integrating insurance, we're really obviously doing the very best thing for our client. Philip Simonson likes to call it creating competitive immunity. We're keeping competition away and we're increasing revenue. Okay, what we find is that many wealth advisors might have 1 or 2% of their gross dealer concession in insurance commissions. And when we have successful plans where we're integrating this on purpose, we've seen that number jump up to 10, 15, even 20% of gross dealer concession in insurance commissions by systematically doing this. So I know we have numbers people on the line. Most wealth advisors have at least a reasonable numbers mind. Just take your gross dealer concession, multiply by 20%, and that's probably the low-hanging fruit that's sitting in your book right now. If we could identify who to talk to and we could help you figure out how to talk to them, we could help those clients and probably find that gross dealer concession, and that might be very meaningful. I've helped a lot of advisors over the years that have changed broker-dealers. It's not lost on me that that is not a small thing. A lot of times that can be consuming for 3 months, 6 months, or a year, and it can also keep you off the ball sometimes on new production. And so if you're already in a transition and maybe your production might have lagged a little bit, now might be the perfect time to intentionally integrate this and make up the difference. Okay. And similarly, I've helped many advisors go from a commission-based model to a fee-based model, which is great long-term, but a lot of pain up front. I'm sure some of you on the line have probably done this or are doing this. And that's also a beautiful time to intentionally integrate insurance, because again, insurance products tend to pay most of their commissions up front and very little on an ongoing basis, versus the fee-based model, which up front is where the pain is, but over time you make much more. So it can be a very great complement to round out the revenue that you might need in your practice. Okay. So how do we do this? I mean, if you're going to do something on purpose, we have to have a commitment to do something. We call it a shared commitment. So what are you going to do and what am I going to do? Now, we're not here to tell you what you must do. We're here to partner with you to say, what kind of goals do you have? What kind of plans do you have? What kind of experience do you have? What does your clients look like? Where do you feel comfortable? And creating some sort of plan. Again, what am I going to do and what are you going to do? The tip of that sword is identifying and positioning the opportunities. So if we're going to have a plan, then we go, well, where are the opportunities? So we need to identify the conversations we need to have. In order to do this, we obviously need to do something different and on purpose. You can't just go from not implementing insurance to implementing insurance. It's a process. Okay, and changes can be hard. I have a friend who is a clinical psychologist, and he says that people respect wisdom, but they obey pain. And when he told me this a couple of years ago, and I got goosebumps just right now, it was like being hit with a frying pan. People respect wisdom, but obey pain. So what does that mean relative to insurance? You guys are all on this webinar. That tells me right away that you understand the wisdom of being able to do this type of work for your clients. And in fact, everyone can understand that. It makes sense if it's done right. But we obey our pain. Well, what kind of pain? Well, the list is long. I got to talk about insurance. I got to be an insurance person. I have to go through the underwriting. I have to do something different that I didn't do before, and change can be hard, but that's why we're here to help you. And if we can help you make that change for you and your clients, guess what? We get ours. That's that platinum rule. To the extent we can understand and meet your needs, then our needs are ultimately met. And in order to do this, we have to ask the right questions. You see, there was a saying that I learned at Northwestern Mutual that said that, quote, the sale was made in the fact finder. What they really meant about this is that it's through the questions that you ask that determines the ability for your clients to take action on your recommendations. Because through the questions, you are determining what's important to them, and you're finding the compelling reason by which they might pay those premiums. Which premiums? Any of the premiums, all of which are too high. Out of context, every insurance premium is too high. But in the context of me, see, if you're going to fact find and ask me the right questions, you got to figure out that I promised my wife that if anything happened to me, that she can maintain her lifestyle, whether I die or become disabled. Okay, and that's my promise. That's what's important to me. And that's why I pay for my insurance premiums. But had somebody just given me a list and say, here's the quotes and here's what it costs, I may not have taken action. But I took action because it's a demonstration of my goal and demonstration of my love to my wife. And so there's this idea that you have to touch the heart before you touch the mind. And so that's where these conversations become very important. Okay. And then we have to, again, as we indicated, define the process. Who does what? How do we make this happen? So where do we effectively start? I mean, at the end of the day, we can certainly say anything that we want to you, but we've got to be able to demonstrate that we can do this for you. And so what we like to do is we like to start with 3 or 4 client conversations. Okay, so clients that you currently have with high trust relationships. So that's the most important. If you don't have a high trust relationship, we don't want to start there. Because without that, now we're going to have this uphill battle. So we want strong relationships. Then we want to cross-reference those relationships with the planning opportunities that we might have. And then what we're asking is not to go sell insurance to that individual or put us on the phone with them. We want to talk about them. Tell us what you know about the Smiths. What have you done for them? What's important to them? What's the risk tolerance? What do you understand about their health, etc.? And we talk that through and form a game plan. Okay, so here's what I think we ought to do and what we ought to bring to the Smiths. Okay, and it really starts there. What I find with any change is you have to find momentum, and that's candidly why we ask for 3 to 5 clients. If we literally do this with 3 to 5 clients, we're going to find momentum. Not only are we going to find momentum, but you're going to know better, are these guys that we can really trust? Are Rod and George guys that we can really trust to do this? And we're going to understand more about how you work, and you're going to understand more about how we work. And in 3 to 5 cases, we're going to understand real well whether or not we have the basis for a successful relationship moving forward. And so that's effectively what we're asking for, is give us the opportunity to work on 3 to 5 cases with you. Okay. So what would those look like? Remember, we told you that we really talk about identification and positioning. So identification is step number 1. Who do we talk to? Okay. So I have here 5 examples of people that I would suggest that we talk to. The first is the high wage earner that is maxed out qualified plan. Why? Well, if they've maxed out a qualified plan, that generally means that they aren't eligible for a Roth IRA, or maybe they've maxed out their Roth IRA, right? And so we have a lot of clients that might want to put in another $5,000, $10,000, $20,000 a year into their retirement account. To the extent that they'd like to do that, well, they should consider, right? They should consider utilizing an insurance contract for accumulation purposes, whether it's a VUL or an index universal life, to create a supplemental retirement bucket for them in retirement, and do so on a tax-favored basis. If you structure policies correctly for accumulation, you have a 20-year horizon to accumulate that wealth, what you often have is you can see your cost structure shrink to 1% a year or less. Right? So if you get a 6% return, for example, in your indexed UL policy, you might end up with a 5% net internal rate of return, net of all of the costs over 20 years, which means that the insurance itself and the tax umbrella that comes along with the insurance can be minimized to under 1% annually for the right clients with the right design. And that's just incredible, especially when you compare that to the taxable equivalent yield. In that example, if I have a 5% tax-free return, what is the equivalent taxable return in a different account? And a lot of times what we find is the cost of insurance can be less than the cost of taxes for our best clients. Now, by the way, I'd like to ask you, do you think taxes are going up, staying the same, or moving down? All right. So our best clients, they're going to have increased taxes. And I'm not saying every one of those clients needs an indexed universal life policy. What I am saying is every one of those clients needs to consider whether or not they should utilize that type of structure to fund a supplemental retirement bucket for themselves. I hope you see the distinction there. Let's consider what that looks like, okay? Second one, pre-retiree or retiree that needs to have a conversation around retirement portfolio protection. Another good example about positioning, okay? Long-term care insurance is a wrong positioning, okay? Everyone thinks long-term care insurance is too expensive, and I don't specifically disagree. But it's not long-term care insurance. What it is retirement portfolio protection, because that's what it does. What long-term care insurance does is it protects the retirement portfolio. The question is, what is the effect on the portfolio and the income if we have to double dip, right? We're trying to take our $80,000 annual income that our plan says that we're going to take for our own retirement, but now one of us is ill and needs long-term care, and now we have to double dip into that portfolio. What's the effect of that? Would you like to understand and consider solutions where you can minimize that risk? Because relative to long-term care, people get really confused often. There's really only two options. Your client can accept their risk that they need long-term care and keep all their money and just self-insure. That's option number one. Option number two is to transfer some of that risk in some form or fashion through the implementation of long-term care insurance, of which there's multiple structures and strategies, which we'll review in future calls. But you've got lump sum structures with both life insurance and long-term care together. You've got lump sum structures with annuity and long-term care together. You've got pay-as-you-go structures with life and annuity on a single life and a joint life basis. And you also have the traditional long-term care coverage. And so oftentimes, if we get in the right kind of conversation there, we can just describe what I call the 3 or 4 lane highway for long-term care planning. And we can educate them on what their 3 best options are to minimize their risk, have them consider whether or not they'd like to implement. And what we find is 80% of the time they do implement it because it makes sense. But if you go to that same client and say, I think you should pay $8,000 a year for your long-term care insurance, good luck with that kind of conversation, right? And that's what they often do. Here's the quote. The quote's too expensive. We'll think about it. Okay, I'll ask you next year. All right, I'm not trying to be rude, but I see that happening a lot. And if our job at a highest level is to motivate our clients to operate in their own best interest, which is what I believe all of our job is, then we have to take a leadership position. We have to do something on purpose. We have to educate our clients. We have to ask them to consider making good decisions for their family and for their plan and for their business. And if we do this correctly, my history shows that we can have 80% of these people say yes. And if we can do that, we can help a lot of people and we can drive a lot of revenue. The third bullet point there is the business owner that hasn't planned for succession. So what I find about business owners is they're often not great investment clients, unless you have the 401k perhaps, because a lot of times the money is still in the business and we're waiting around for that liquidity event for that business to be sold. Well, there is an enormous amount of insurance opportunities for small and mid-sized businesses utilizing insurance. That could be funding buy-sell agreements, funding key person arrangements. Okay, it can be legacy and estate planning. A lot of times, large businesses in particular create a liquidity risk inside of the estate plan, right? And so insurance can often create liquidity for a business owner. Furthermore, sometimes a business owner might have 1 or 2 individuals in the business, maybe their kids, and 1 or 2 kids outside of the business. And I say business, it could be a family farm as well. So a lot of times we have estate equalization and liquidity opportunities whereby maybe children number 1 and 2 are going to inherit the business, but we want to treat children 3 and 4 equitably. And sometimes we can do that with life insurance. Again, it's back to should we consider whether insurance makes any sense inside of your business plan, right? So again, these should hopefully be flags that are thrown up for you for clients that you may have. If you haven't already, you might even want to jot down a couple of names. Because if we have the privilege, George or I have the privilege of talking to you, we're going to want to know, who are the first 3 clients that we're going to work with? Tell me about the Smiths, right? So that's the business owner opportunity. Number 4, this one I think is the lowest hanging fruit in my opinion today, which is the retiree that likes to sit on what I call safe money inside of bank accounts. Any money that's inside of bank accounts today have probably the following attributes. Number 1, very little to no interest being generated, plus taxable, right? Secondly, it's not under management, so you're probably not earning a fee on those dollars. And it's probably for emergency funds, and it's probably for long-term care funds, and it's probably for legacy. And so if we start having a conversation with these folks about the $300,000 that's in the bank, what do you intend to use that for? Are you aware that you're effectively losing money safely in the bank? I don't want to be rude, but that's effectively what's happening with the erosion of inflation, right? And so we can utilize all kinds of single premium products that will give us all of our contribution in the first year, or maybe within a 3 or 5 year period of time. We can leverage up from a death benefit standpoint. We can leverage up dramatically from a long-term care standpoint. And the bottom line is we can effectively give them more net interest than they're earning today in the bank many times, and provide leverage for long-term care and for death benefit. And we can do that by repositioning assets. Okay, back to positioning. Okay, it's one thing to pay a premium, and no one ever wants to pay a premium. But what if we created an asset? Okay, and what if that asset, we just had to reposition other assets we already had? So what if we were just repositioning 100,000 of this $300,000 that's in this bank account, and we're doing it so that we can more specifically fund their goals and their plans? And we do that through education and ask them to consider those things. By the way, when you do a lump sum like that, it's usually a simplified underwriting process. So when you think about how painful the underwriting process can be, it's much less painful with these lump sum products, in no small part because the client is paying effectively all their premium up front, which makes it a little safer for the insurance companies, which allows them perhaps to have a more streamlined underwriting process to get that done, and they can be a little more liberal with who they approve, right? So if you're not familiar with these products, please reach out to me or George. I think it's the low-hanging fruit because I don't see interest rates moving up at all anytime soon, and our clients are losing dollars, and all we have to do is reposition those dollars. That's all we have to do. Okay? The last one is the retiree that has RMDs that they don't need. You're probably familiar with the Secure Act. One of the things that the Secure Act says is now for inherited IRAs that are non-spousal, we have to take those distributions over 10 years or less. Now that could be a problem. Okay, if I were to inherit an IRA today and I had to take it out over 10 years or less, that means that those distributions coming to me are at my highest marginal tax bracket, and I can no longer stretch that. And depending on what bracket I may be in, that could be very expensive, and that's without future tax rates going up. And so you may have clients that have more money than they need for themselves and are likely to pass on to future generations, whether it's in an RMD or others. And if you have clients that are likely have assets they're going to outlive, they need to consider whether insurance can be appropriate. We can utilize guaranteed universal life structures and guaranteed second to die universal life structures that create an asset that's guaranteed, non-correlated to the market, and income tax-free to the heirs. And this can be very advantageous. If we have a 71-year-old today that's putting $10,000 or $20,000 a year into one of these policies from an RMD that they don't need, we can generally get 20-year internal rates of return in the 4 to 6% range. Meaning that if I put my $10,000 a year in for 20 years and I get my death benefit in that example, I have a return on my death benefit between 4 and 6% generally. And that return would be guaranteed based on the claims paying ability of a company, non-correlated to the market because there's no investment component, and income tax free to the heirs. And so that can be a very viable structure and one by which we deal with a lot. If you look at my personal practice, which is doing joint work with wealth advisors, and you look at these 5 identifiers, I'll bet you 80% of everything that I'm doing was found by one of these 5 strategies. So I don't consider myself wholesaling insurance, even though we're technically a brokerage wholesaling firm, but I do think that we wholesale ideas. And these are the types of clients that we need to bring ideas to and have a better conversation with. Okay. The important part about this, among other things, is to not view the insurance in a vacuum. Okay. Do you want the insurance? No, I don't. Right? Do you want this product or this product? In a vacuum. We want it in context. And the best context is the financial plan. Certainly, if you're putting together a bona fide plan, that's ideal, but it could just be a yellow pad plan, right? But we want to have a plan, and we want to help understand how insurance fits into it. And the insurance in and of itself is just a funding vehicle. It's just an asset class, right? By the way, it's an asset class that many clients do not have. And the more affluent that individual is, the more likely they need to consider the asset class of insurance. Because we can create an alternative class and it behaves differently, right? And we get guarantees. Now, many people don't think about life insurance companies being professional risk managers and professional money managers, but that's exactly what they are. If you take my previous example of that 70-year-old putting $10,000 a year away for 20 years and getting that 5% return, well, that's a professional money manager guaranteeing that. And if it wasn't called life insurance, but I could bring you a product today that would give you a 4 or 5% guaranteed income tax yield for your clients over 20 years, would you put some of your clients' money in that asset class? And I think the answer to that is yes, I would. But what if that asset class was called life insurance? Oh, okay. Well, now we got a problem because it's life insurance and 70-year-old grandma doesn't need life insurance. So now we got a problem. So why are we selling insurance to grandma? Well, my answer to that is we're not selling insurance to grandma. We're creating an additional asset class for her that behaves differently than other asset classes. And I concede and agree that she doesn't strictly need it, not in the way that a young family needs it to replace income and pay off debt, but she may want it. And see, that's the key. When we have the right conversation, then grandma wants it. She goes, wow, you mean that I can get those returns and I don't have to be in the market? If you really do it right, they always say something like, wait a minute, how could they even do that? How can you even do that? If that question comes out, we know we're golden. Well, how we can do that is you have to qualify for this, right? Insurance has to be qualified for. And by the way, the qualification isn't pass or fail. It's pass and slot, right? So depending upon where you're slotted. So grandma, if you like this idea, then what I suggest we do is we go through an underwriting process so we can solidify the pricing structure for you before we take action. Let's not write any checks. Let's make sure we can get it because we have to qualify for this, right? And that's why it can be so good. And what I really want you to hear is that if we do this right, we can consider the asset class of insurance where it wasn't considered before. And when we do this appropriately, clients' attitudes shift from should I or shouldn't I put any of that insurance in place to how much of that insurance should I put in place? In what form, in what fashion, and what design? So a lot of what I think we do is we really custom design these insurance structures inside of the context of the financial plan or the estate plan or the business succession plan. And again, to the extent you're actually using software, we're pretty familiar with a lot of the planning software out there, Money Guide Pro, eMoney in particular. So we can help you navigate those. If you wish to do it more formally, we can kind of bolt on, if you will. A lot of words coming out to me. So I want to bring George in here. So here's our USAdvisors team. I'll have George introduce himself in just a minute. He's going to be your lead marketer. Okay, so what that means is you've got a guy and you want to talk that through and you want to grab some illustrations. George is going to be able to help you do that. We'll talk in a minute on how you might utilize me, but George is going to be your dedicated person there. His backup and his peer is Andrew. So he's also our internal marketer. You may talk to him occasionally, but generally George is going to be your first line. Then you've got David, Romelhart, and Lisa. They are both our case managers. We're a tight team. We're in Eden Prairie, Minnesota, by the way, or at least George and the home office is. I'm outside of Chicago. I think you see Brian Urlacher here in the back. I can't move the right way. My camera's backwards. So I'm outside of Chicago. Please don't hold that against me if you're not a Bears fan. And give me some grace, because it's hard to be a Bears fan and a Cubs fan. It's tough. You probably know that. And then Dan Thompson. Some of you may have even received a call from Dan, because he's our business development person. And as you all moved over to Securities America provides us a list of those new reps. And so you may have even heard from him, and you might hear from him in the future to try to set up a call with George. So with that, I want to take a step back, bring George on, have him introduce himself a bit, and then we'll move from there. George, the floor is yours.
Well, thank you, Rod. It's always very exciting to hear you pull this all together. And hello, everyone. Appreciate you joining the call. With over 20 years of insurance and other sector experience, I'd self-describe myself as a team builder. And that is not only as an asset to your relationship, but it also involves harnessing across the businesses numerous carrier resources, valuable information from industry leaders. I find myself on the phone almost in equal measure at times with all the many places that I can call together on your behalf. And it may be case specific, or it may be just new insights about upcoming trends, but that's what I try to bring to you. And of course, you should expect delivery of a wide range of innovative case strategies. Rob described many of the opportunities. I join right into those, and identifying those is certainly a big part of it. But there's another half, that commitment to execution detail. Sometimes I find myself vacillating between both sides of my brain. Hopefully that's a good thing. And I think what I've come to realize, both are equally important, because getting it done after the ideas are formulated, after the case is in motion, I've seen sometimes that's where things can drop off, but that's wouldn't be in my pedigree. So you can count on two halves of the brain here. And also, you know, as I talk to my clients, because I do ask for their feedback along the way. And just recently, I was introduced to a new advisor, much like you will be to me. And I asked another advisor I've been working with just to make a brief introduction. And he simply said, "I'd like you to meet George. He gets it." And I thought, oh, that's brief. But that is short and sweet, and really what I want to hear. Because if I can wear your shoes, if I can hear on behalf of you and your clients how you want to integrate insurance in your practice, we all win. And actually, because I won't have the opportunity to meet your clients and get to know them as deeply as you will, I do deeply care about not only the results, but the outcomes for them. Again, I think that's in our human nature, and that's something I bring as an aspect to my business. And on the personal side, just to add a bit, I'm married, I have 2 daughters, I enjoy skiing, I enjoy scuba diving, and I don't get to do either near as much as I like to, but I do enjoy, again, all kinds of recreation and the North Country up here in Minnesota. And I really look forward to getting to know you all better all across the country, and making our firm a valued go-to agency. Thank you.
Beautiful. Thank you, George. Yeah, George really is a tremendous resource. And to pick up on what he said, he definitely is very attention to detail. And that's really important. If any of you have done insurance business, and I presume most of you have, there's like asterisks everywhere. And so I always describe it as being a little bit clunky. So every company is a little bit different, every product's a little bit different, and really paying attention to details is very important. And our case managers are very good at that as well. And the number one thing that I think you'll get from us, and I hope you already feel it from us, is that we care. And George did indicate that. Because listen, we can't tell you that everything's going to be smooth all the time. In fact, it's not. It can't be. The insurance just doesn't go that way. But what does happen is our team cares. And so we're taking action all the time and being proactive. And then once again, to my previous comments, we can effectively say what we want. At the end of the day, we want the opportunity to be able to demonstrate this to you through working on 3, 4, or 5 cases together. So that's, again, what we're going to be asking you to do. And then you can determine for yourself, just like George's referral said, hey, George gets it. Well, he might as well have been saying, hey, George really cares, and he's going to take care of you. And so please give us that opportunity. So we would like to offer you something called the Champions Group. So to the extent that you want to work with your clients yourself and you feel comfortable doing that, you can certainly utilize George on our team, and you can keep all of the commission. And I suggest that you do that if you don't believe that you need help. But I imagine there may be some of you on the call, or some of you that might listen to this later, that might want some help on a point of assistance basis with clients. And it wouldn't have to be across the board. It might just be 1 or 2 clients, depending on the complexity of a case. But to the extent that you wanted more formal coaching from me specifically, I do have around 15 advisors right now that participate in my Champions Group. And that Champions Group is meeting with me on a systematic basis, usually once or twice a month on a one-on-one basis, to systematically and intentionally cultivate cases. And then inside of that, then I take the driver's seat as a member of your team, and ultimately bring me into phone calls and Zooms to direct that at a client level. And to the extent that you would want to consider doing that, you can reach out to me directly. But to be very clear, you don't have to work with me, nor do you have to give up any commission. You can work directly with George. But to the extent that you just want me on your team without being on your payroll, like many other advisors have done, that would be where you could utilize me. What I find is, Philip Simonson calls that the teaching hospital scenario. What I find is that a lot of times I work on 5, maybe 10 joint cases with an advisor, and sometimes I move myself out of a job, because now the teaching hospital, it's not rocket science what we do, but I'll tell you, I've cultivated thousands of these cases. And if you've cultivated a handful, I don't mean to shame you or boast, but if you've just done a handful and I've done 1,000, there may be some tips, tactics, and strategies that I might have that might help you. And by the way, hopefully you'll gather some of that even today. And on our Coaches Corners, which we're going to talk about, we're going to do some coaching for you on a monthly basis. And I'm going to describe that in just a minute. But I want to remind you that, again, systematically, we found 15 to 20% of gross dealer concession available without having to pull in a new client, right? And a lot of times the best time to bring this up is in your annual reviews. If you're like a lot of advisors, those annual review meetings are set for an hour. We spend about 45 minutes catching up on family, 5 minutes on performance, and then we're sort of done. Well, that can be a great opportunity to ask if they want to engage in an insurance review or a risk management review. And oftentimes that's the best part, or the best time to grab that person effectively and get them in a process. Okay, so if you want more information, please reach out to me. I want to share a couple more case studies, and then I'm going to describe the support we're going to create for you guys starting next month, and then we'll go into questions and wrap up. We're at 10:43 right now. So this is a case study that we actually have in underwriting right now, which is back to repositioning assets. So what we have here is we repositioned $900,000 from old non-qualified annuities that the client didn't need for income. It was designed as legacy dollars, and they were in some old index products that the advisor didn't like. I think we had an S&P cap of about 2.25%. And so there was just no opportunity for growth. And so what we did and what we're doing is we're repositioning this $900,000, $150,000 a year for 6 years for this 72-year-old individual. And what ends up happening is that we buy $1.4 million of death benefit. So we're putting in $900,000, but we get $1.4 million out. And then the question is, how good of a return is that? Okay, if we do that over 10 years, if he passes away at 82, his return is 6.1%. Now again, that's guaranteed based on the claims paying ability of the company, non-correlated to the market, and income tax free to the heirs. Okay. Now the 20-year number is 2.6, so that's his age 92, right? So over 20 years for this individual, we have a 2.6% return or better. That's non-correlated income and estate tax free to the heirs. And what would the taxable equivalent yield be of 2.6? And again, this is a fixed asset, okay? And it shows up in cash. And so this can be a really great opportunity to give you an example of how we reposition these dollars. It shows up in cash. By the way, we know the ending value. Okay, that's sometimes lost. This asset has an ending value of $1.4 million. Is there any value to that? Now, the commission on this is roughly $50,000 as well, just so you're aware. So if we help this client create a better legacy asset with part of their assets. Now, you don't know everything about this case, but this is about a quarter of the investable assets, right? So it's a sleeve, so it's an asset class. How much should be in here? So we described this strategy and said how much. Candidly, I was surprised they wanted to put this much in. It was the wealth advisor, primarily because he really, really hated the indexed annuities that this thing was in and had to do something with them. And by the way, you go into another annuity in today's environment, we have very low rates. So here we have the opportunity to probably get between 2.6 and 6.1, depending on what's going to happen, right? It's death that triggers this, which is what makes it non-correlated, right? Non-correlated to the market. So keep this kind of structure in mind. Here's another one that's a little bit more involved and very interesting. I believe that these clients are maybe the perfect candidate for an insurance conversation. These are a 45-year-old couple earning $500,000 a year. They have 2 children, actually twin boys, extremely family oriented. So they're all about taking care of their kids. They've got huge 529 plans. There's private college. They definitely want permanent insurance. They want to leave a legacy. They're just very, very family oriented. When we asked them to prioritize their goals, protecting their income was the #1 goal because they're 45 earning $500,000 a year. That's a huge money machine, right? The next 20 years, that's going to be an enormous amount of money. So priority #1, protect the income stream. Priority #2, create supplemental retirement income. They've maxed their 401k plans. Okay, they're paying a lot in taxes today. They're going to pay a lot in taxes in the future. So can we create a supplemental retirement income that's tax-free to them? They don't qualify for a Roth IRA. And then finally, creating and transferring wealth is important to them. Okay. So what we did is we did a couple of things. So for the gentleman, we put $2 million of level 20 term in place, plus a $250,000 IUL for accumulation purposes. They had some term insurance besides. For the wife in this case, we put $1 million of level 20 term in place and a $250,000 IUL contract. We're funding these over 7 years, so it's maximum non-MEC premiums. And we're also creating the opportunity to convert the remaining term in year 8. So the way we have this structured, we can only fund that IUL for 7 years and then we're done. But now we can pick up a new bucket and we can do so by converting term insurance without requiring evidence of insurability. Okay. The insurance drag for these people over 20 years was 1.5% annually. Okay, and so that's really what they're trading off is the cost of insurance versus the cost of taxes. If we were funding for more than 7 years, we could get that down further. But with these people, this rolling 7 years makes a little more sense. We don't have enough time today to go into the details of that, but it's into product design and it's into the MEC rules, of which are now changing. So we'll be bringing this to you in the future. But with the new rules that came out just in December, we actually have the opportunity to put even more money for our clients inside of their life insurance contract without creating a MEC. And so that means that these accumulation strategies are actually going to start looking much better into the next year as new products roll out. We'll be bringing you this information in the future, but that's a little sneak peek for you, okay? And again, the term is convertible to IUL. Okay. We also put together a $1 million second to die policy for them. So normally we wouldn't be putting a second to die structure in place for a 45-year-olds, but it's very important for them to transfer wealth. And when you look at these numbers, you go, oh my gosh, this is amazing. It's an insurance company, professional risk manager, professional money manager. We set them up with 20 years of premium so that they don't have to keep this into retirement, right? So they're working to 65, 20 years of premium, $64.60 a year times 20 years. We have total contribution of $130,000. That's what we're putting into this thing. What we're getting out of this thing is $1 million on a second to die basis that's guaranteed to age 120. So look at that 60-year internal rate of return. So they're age 105. They're age 105. They got a 4.08% return, guaranteed, non-correlated, and income tax free. The 50-year number, they're age 95, maybe the age that you're running your financial plans out to. 5% return. This is a fixed account. There's no investment risk here, and this is tax free. So what do we have to get in equities to get a 5% tax-free return over 50 years? Depends on the tax bracket, right? So this is why when we do this right, we're describing an asset and saying, does this asset make sense for you to have? And if so, how much of this asset ought you have? And so I was personally like blown away at how great these numbers look, because it'd been a long time since I've looked at a second to die structure on somebody so young, right? So those just give you a couple ideas on a couple of the case studies that are real life cases that have been worked on or implemented in the last like maybe 3-4 months. Okay. So it's 10:50. So from a next step standpoint, we're going to go into questions. What we're going to bring to you is we're going to do a monthly coaches corner. That's what we're going to call this webinar. And we're going to do that on the third Thursday of every month, starting in February, on February 18th at 1 p.m. Central. Okay, so that's going to be our next coaches corner. I'm going to go into top 10 objections and how to have better conversations around those. So that's what we're going to talk about. What are you going to hear from clients? You start having conversations with them, you're going to start hearing pushback. And I want you to be prepared for what that is. And so we can put that in context. And so we're going to talk about those objections and how to position what we're doing and how to talk about trade-offs. We also have a structure we call Always Be Learning. So on the second and fourth Thursday of every month, you're going to receive an email from us with something timely, some sort of topic relative to insurance integration or relative to the marketplace. We call these our Always Be Learning. You know, if you're not learning, you're effectively not growing, right? And so in order to grow, we need a commitment to lifetime learning. So you're going to effectively get 3 touch points from us each month. A coach's corner, and it's going to be couched by 2 of these Always Be Learning communications. Okay, we're going to show you in future, we have an advisor toolbox. So we have this beautiful tool. If you reach out to me or George, we'll make it available to you, and we'll talk about it in future calls. But we have a toolbox that is designed to have everything we need to intentionally integrate insurance into our practices. This gives us scripts, profiles, different trainings that we've done, links to the streamlined application processes. There's a lot of information in here. And that's sort of the receptacle by which we place everything that we need to intentionally integrate insurance into your practice. And then once again, the recent experience indicates that we can find real money here by doing what's in the best interest of our clients. And so lastly, you will receive a phone call if you haven't already from George or Dan on our team, primarily to ask for an initial call with George so that he can understand more about who you are, what your practice looks like, what your experience has been, what kind of clients you work with, how you feel about insurance overall, so that we can determine what sort of shared commitment can be put in place so that we can help you help your clients and ultimately drive revenue to everybody involved. So you'll be getting phone calls, and this is how we intend to follow up. So with that, I would like to open back up for questions. Does anybody have any questions or comments or concerns? It's 10:54, so we've got about 6 minutes to the top of the hour. So if you have questions, go ahead and unmute yourself and just speak up. All right. Jeff, anything else from you to wrap up this call then? Or any questions or comments or anything you wish I would have brought to the group?
No, I thought it was wonderful. So really appreciate it, Rod.
Okay, well, I appreciate you guys. So then with that, here's my contact information. And again, you can reach out to me or George and look for communications for us into February. And please mark your calendar for February 18th at 1 o'clock, where we're going to do our next Coaches Corner. George, anything last for you to to convey? Any last thoughts from you?
No, like I say, as I said, as a team builder, but it's also within our team. I mean, my relationship with you, Rod, I mean, two heads are better than one many times, and you can count on a real assembled response to all the opportunities and unique solutions that we can put forward. And it's enjoyable to do it, and look forward to bringing that to your practice.
Beautiful. So I just put George's contact back up on the screen. He's at extension 6108. We look forward to earning all of your business. Please give us the opportunity. We appreciate being invited onto this call. And it's 10:55, and I'm going to go ahead and terminate this call. And if you need anything, please reach out to us. Jeff and Lisa, I really appreciate you organizing this, and I appreciate everyone's time.
Thank you.
Thanks, George.
Have a wonderful day, everyone.
Thank you.
Take care.
Bye now.
Thanks.
Bye-bye.